This video is about royalty. Wait, not that type of royalty. Instead, the type of royalty I'll be looking at in this video involves payments to you when someone else makes money using your tangible or intangible property. I'm the Tax Geek, and here are royalties, oversimplified. First, we have to answer the question, what is a royalty? Royalties are payments that are made to you when someone else makes money using your property. This is different from rents, which are payments made to you when someone else simply uses your property. Royalties can either be a percentage of the income generated or paid on a per-unit basis. Taxpayers are most likely to see two types of royalties. One is for minerals or other resources extracted from a piece of land you own. The others are payments for the use of your intangible or intellectual property. Let's say you own land on which you've allowed an oil company to place oil wells. You're allowing the oil company to make money off the mineral rights under your property. The oil company will pay you a royalty based usually on the number of barrels of oil they extract. Or you could have created something such as a piece of writing, music, photography, or video that you're allowing others to publish, sell, or broadcast for direct or advertising revenue. Or it could be a patented invention that you're allowing others to manufacture and sell. In all of these cases, you own intellectual property that you're allowing others to exploit for profit, thus entitling you to royalty payments. Now that we know what royalties are, how are they taxed? Well, if you've been a regular viewer of this channel, it won't surprise you when I say that this is another one of those situations where it depends. If your primary source of income is something other than the royalties, they are taxed as royalties and reported on Schedule E, page 1. For example, Devin is a university professor who receives royalties for writing a textbook. He reports the royalties he receives for the book on Schedule E, page 1. However, if your primary source of income is from royalties, the royalties are considered business income and reported on either a Schedule C or other business returns such as a 1065, 1120S, or 1120. Anne writes mystery novels, and royalties are the main source of her income. She reports her royalties on Schedule C, or if she has an LLC or corporation, 1120S or 1120. Why the difference? First, royalties reported on Schedule E are usually not subject to self-employment tax, whereas business income reported on Schedule C is. Second, royalties reported on Schedule E are not qualifying business income, and as such, they don't qualify for a qualified business income deduction. Royalties reported on Schedule C, or Form 1065, or 1120S are considered qualifying business income in computing the deduction. Third, royalties reported on Schedule E are considered to be passive income, and any losses associated with the royalties can only be used to offset other passive income sources, such as rents or income from business activities you do not directly participate in. If there are losses associated with royalties reported on Schedule E that cannot be used to offset other passive income, they are carried forward and used to offset future potential passive income. On the other hand, ordinary business losses can often be used to offset other income sources. Finally, royalties reported on Schedule E are considered unearned income. Royalties reported on Schedule C are considered earned income, which is essential in claiming an earned income credit, refundable child tax credit, child care credit, or contributing to an IRA. So how exactly is royalty income that is not specifically business income reported? First of all royalties are reported to you on Form 1099 MISC in Box 2. This amount is reported on the first page of Schedule E. You may recognize this schedule from the Taxes for Landlords series. We're going to fill out this Schedule E for Esther, who owns land containing several oil wells. A drilling company pumps this oil out of the ground, which they in turn sell to one of the large oil refineries. Esther is retired and not in the oil business, and the royalties only represent a small portion of her income, which, in addition to the royalties, contains Social Security, a pension, and investment income. From the drilling company, she receives a Form 1099 MISC showing royalties in Box 2. She also receives a statement from the company listing expenses associated with the royalties, usually local taxes. Let's go ahead and fill out her Schedule E. For the Box 1A description, she enters ABC drilling royalties on line A. In Section 1B on line A, she enters 6, indicating that the entry is for royalties. She then enters the amount of the royalties on line 4 in column A. On line 15, Esther enters the taxes from the statement she received, also in column A. Since she has no other rental or royalty income, she simply totals the income and expenses, and the net income ends up on line 26. This is transferred to Schedule 1 line 5 and ultimately shows up on line 8 of her Form 1040. Of course, this is not everything involved with the taxation of royalty income, and additional information and resources are linked in the video description. If you liked the video and found it informative, a thumbs up would be most appreciated. Subscribe to the channel to see more oversimplifications of our overcomplicated tax system. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.